Welcome back to one more video. Today, let's talk about something that pretty much every Canadian investor has to deal with at some point: capital gains. Now, I know I can sound a little intimidating, but trust me, we're going to break it all down. By the end of this, you'll get exactly how it works. Let's dive in. So, have you ever sold something for more than you originally paid for it? You know, maybe some stocks that did really well, a rental property, maybe even a piece of art? If you have, then congratulations, you've got yourself a capital gain, and that means there are tax implications. But how much tax are we talking about? And how do you even calculate it? Well, that's exactly what we're here to figure out. And right off the bat, this is probably the most important thing to understand. If the government sees your profit as business income, 100% of it gets taxed. But if it's a capital gain, only half. That's a massive difference, right? So getting this distinction correct is absolutely crucial for your wallet. Okay, so here's our game plan. First, I'll explain you the analogy of the fruit tree. Then we'll get into the actual math. After that, we'll cover some really key rules and adjustments, peek at some special situations with stocks and options, and wrap it up with a cool way you might be able to defer your tax bill, known as capital gain reserve. All right, let's jump into our first section: fruit tree or just fruit? This is all about telling the difference between a capital gain and straight-up business income. I love this analogy the courts came up with. Think of it like this: if you own an apple orchard, the apples you pick and sell every year, that's your inventory. The profit you make is business income. But what if you sell the whole tree, the thing that produces the income? Well, that tree is your capital property, and the profit from selling it is a capital gain. See the difference? So how does the CRA know if you sold the fruit or the whole tree? Well, they look at what you're actually doing. They're basically asking, did you buy this thing to hold onto it and generate value over the long haul? Or were you just trying to flip it fast for a quick buck? They'll look at how often you do these deals, how long you held the asset. All these factors paint a picture of whether you're an investor or running a business. Okay, now that we know what we're dealing with, let's get into the numbers, Section 2. The core calculation. We're going to build the formula for figuring out your gain or loss step by step. First piece of the puzzle: proceeds of disposition, or just POD for short. This is basically everything you got in return for the asset. And it's not just the cash you pocket. It could also be the value of another property you traded for, or if the buyer took over a mortgage for you. It all counts. Next up, you need to know what you paid for it. That's called your adjusted cost base, or ACB. This starts with the purchase price, but you also get to include other costs you had to pay just to get your hands on it, like legal fees or commissions. And the final piece is your expenses of disposition. These are the costs you had to pay to sell the thing. We're talking realtor commissions, advertising, legal fees to close the deal, all of that. And you definitely want to track these because every single dollar here lowers the amount of gain you have to pay tax on. And there it is, all put together. It's super simple, really. You take what you got for it, your proceeds, you subtract what it cost you, your ACD, and you subtract your selling expenses. Whatever's left over is your capital gain. And if that number is negative, it's a capital loss. But wait, here's the best part. You don't get taxed on that whole gain. In Canada, there's something called an inclusion rate, and right now it's 50%. That means only half of your total capital gain actually gets added to your income for the year. That half is what we call your taxable capital gain. So what about the flip side? What if you have a loss? Well, 50% of your loss becomes an allowable capital loss. But here's the catch. You can only use these losses to cancel out taxable capital gains. You can't use them to, say, lower the tax on your salary or profits of your operating business. The good news, though, is if you don't have gains this year, you can carry those losses back 3 years or forward forever until you do. All right, we've got the basic formula down. Now let's dive into some of the real-world stuff, the key rules and adjustments that can pop up. So what actually triggers this whole calculation? Well, an obvious one is selling the property, but a disposition, as the CRA calls, it can happen in other ways too. If you change how you use a property, say from your personal home to a rental, that's a disposition. Gifting a property to someone, passing away, or even moving out of Canada can trigger what's called a deemed disposition, where you're treated as if you sold everything at fair market value. And remember, your adjusted cost base, that number isn't always set in stone. It can actually change over the years. For example, if you get a government grant that lowers your cost base, but other things like reinvested dividends from a mutual fund actually get added to your cost base. Keeping track of this stuff is super important because it directly impacts your final gain. Okay, let's get into some common situations for investors like stocks and options. Now, speaking of stocks, remember that fruit tree debate? There's actually a way to avoid it. You can file a special election with the CRA to have all your sales of Canadian securities automatically treated as capital gains. It gives you certainty for sure, but it's a one-time permanent choice, so you gotta think it through. Now, this next rule is a big one. It's called the superficial loss rule. Imagine you sell a stock that's down just so you can claim the loss on your taxes, but then you turn around and buy it right back because you still think it's a good investment. Well, the CRA is wise to that. If you or someone close to you buys back that exact same property within a certain time frame, that loss is denied. Instead, the loss amount gets added to the cost of the asset you just bought back. And here's that time frame we were talking about. It's a 61-day window in total, 30 days before you sell, the day of the sale, and 30 days after you sell. If you buy back that identical property anywhere in this period, and you're still holding it at the end, boom, the superficial loss rule applies. To help you to understand better, look at the Maya's example. So timing is absolutely everything here. Okay, so what if you're like most investors and you buy shares of the same company over time at all different prices? Well, you can't just cherry-pick the most expensive shares to sell to minimize your gain. Nope, you have to calculate a weighted average cost. It's actually pretty simple. You just add up the total amount you've ever spent, divide it by the total number of shares you own, and that gives you your official cost per share. Look at this example of calculation of Indigo shares. Easy, right? It's very important you keep track of your purchase and sales of shares so your accountant can accurately calculate your capital gain or loss. Now let's switch the gears and talk about call and put options. Options trading has its own quirky set of rules. You've got call options, which give you the right to buy something at a set price, and put options, which give you the right to sell. If you're the one who grants the option to someone else, you have a capital gain right away. If the option just expires without being used, the person who bought it gets a capital loss. And if it does get exercised, the price of the option just gets rolled into the cost or the proceeds of whatever was being bought or sold. Let's stick it in your mind with this example of Sophia. All right, last section, let's talk strategy. Let's say you sell a big asset like a business or a property, but you're not getting paid all at once. There's a really handy tool called the Capital Gains Reserve that can help you manage that tax hit. The whole idea of the reserve is that it lets you report the gain as you actually receive the money. It just makes sense, right? Pay the tax as you get paid. So as you see here in the example, in year 1, you'd report a part of the gain but claim a reserve for the money you're still waiting on. The next year, you add that reserve back into your income, report a bit more of the gain, and claim a new, smaller reserve. You can spread the gain out like this for up to 5 years. It's an incredibly powerful way to manage your cash flow. So there you have it, from the fruit tree analogy to the superficial loss rule and the capital gains reserve. We've really covered the essentials. But if there's one thing I want you to take away from all of this, it's this. Knowing the rules is great, but it means nothing without good record keeping. You have to track your costs, your adjustments, your selling expenses, everything. That's the only way to get the numbers, right? The rules are set, but making them work for you, that all comes down to the records you keep. Thanks for watching. If you found this video helpful, don't forget to hit the like button and subscribe to my channel. Stay tuned because our next video is a hot topic. Capital gain exemption if you sell your principal residence. See you in the next video.